Welcome to the Contrarian Capitalist podcast. I'm delighted to be joined today by the Peruvian Bull, Mr. Peruvian Bull, aka Roberto Rios. How are you doing?
Doing very well. Thank you for having me on today.
Really looking forward to this. And we were just chatting off air saying that although a lot of people's focus at the moment is on the USA for a variety of reasons,
Mhm.
actually the country that we're going to start with today and the country that people should really be looking at for a variety of reasons that I'm hoping you can go into is Japan. So let's head over to the Far East. What's going on in
Mhm.
Japan and what do people need to pay attention to?
Sure. I recently released this like little mini doc on my YouTube channel. I flew over to Japan because the Japanese system is this enigma, right? It's this mystery in global macro because for so long they have defied what we would call financial gravity, right? They've run their debt to GDP to 260% of the public sector. They have 180%, roughly 178% of private debt to GDP. They have had 0% interest rates, not for 5 years or 10 years like most countries in the West, but for 30 years, right? Since about 1999. And so most people have this kind of question of is low interest rates are low is low inflation and infinite QE possible in a market economy, especially one that's an export based economy. And Japan had seemed for years to be able to buck the trend and be able to pull all of it off, right? To continue to roll forward the debt at low rates and keep this exceedingly high debt load, the highest in the G7 and the G20 as a percent of their GDP, and kind of defy this economic gravity. And I wanted to go there and figure out what is going on with Japan. How has this emerged? How has this developed? How has this evolved? How can this be possible? And then also what happens when the yen and the bond market finally start blowing out like they have started to in the last few years. And the investigation really began with I guess, deep dive into the history of the monetary history of the Bank of Japan and the Ministry of Finance. These two institutions had essentially differing views on the future of Japan post the Reconstruction and I guess you could call them the Marshall Plan for Japan, the U.S. Constitution and enforcement of U.S. political hegemony on the Japanese system. And one of them wanted to retain the Japanese system of extremely high regulation, extremely strict import-export regulations. They wanted to keep the system as it functioned. But the Bank of Japan, especially key members at the Bank of Japan, wanted to move the system to be more of a decentralized cowboy capitalism, like you call it, like less of a state fascist type system. Because right now Japan is still like a highly regulated system, but even in the 80s and 90s it was even higher. And so the Bank of Japan, due to a lot of different factors, started easing right into the 1980s, especially because after the Plaza Accord, when the Japanese, saw their currency weaken substantially due to this prearranged agreement strengthened substantially against the dollar in this prearranged agreement called the Plaza Accord to weaken the dollar and to make the global trade market more liquid and more accessible for more people because the strong dollar was wrecking the global economy, right? The yen and the German mark were benefiting from the weak currency and the increased exports, but the U.S., like I call it, domestic manufacturing sector, especially the auto companies were really hurting because the strong dollar was making it very hard for them to sell overseas. And so, in the wake of that, with the strengthening yen and I guess you could say capital reallocation back to Japan, the Bank of Japan was worried that this would cause a recession, that the contract and exports would leak over to other areas of the economy. So they eased substantially, right? They lowered rates to 2.5% by 1986, and they were engaging in something called window guidance, which meant printing, basically like forcing commercial banks to make loans. And this contributed to a massive asset bubble, which peaked in the late 1980s. Actually, like December 1989 was like the top tick on the Nikkei. And then for 20 years, essentially, the Nikkei and the real estate market and the bond market had a slow motion train crash where the system was just bleeding every single day. And, the Bank of Japan tried more and more desperate measures to try to stop this, this slow motion crash. And the first they obviously brought rates down to low bound, and then they pinned them at zero in 1999. In March 2001, they did QE. In 2010, they did QE2. In 2013, they did something called QQE, which was even more aggressive and entitled buying corporate equities in the form of ETFs. They bought real estate ETFs, REITs. They were buying more and more bespoke types of agency and non-governmental bonds. And all of this essentially failed. But what it did was it allowed Japan to be the what I call in my Substack the monetary experimental lab, right? The monetary
Mhm.
proving ground for new forms of monetary policy. So, QE, QQE, yield curve control, all of these ideas, even 0% interest rates, really, were all pioneered and perfected in Japan. And so it's become this, I guess you could call it like a signal, right? A bellwether for the rest of the global, monetary authorities because they can watch what happens in Japan and see how it works, and then they can try it in their own countries. And so it wasn't until the 2010s that the rest of the world started to follow suit with 0% interest rates and then negative interest rates, and then QE obviously in a major way post 2008. But all this ended up being a test run for the global financial system, and we've seen the consequences can be quite catastrophic. But I'll leave it at that, and you can piece apart any part of it you want.
Well, I think that's a very good summary, to be honest, of where Japan was, in the 80s, 90s, and then up to the
Mhm.
2010s. And I think that if we're going to go down the same path, all we have to do is, I'll put a link to the video that you've done. So I'd highly recommend people watch that because it's very informative. So is it a case of history's going to repeat itself, or are we seeing other issues in the surface in Japan coming to the forefront at the moment?
You mean history repeat itself in the form of Western countries facing the same Japanification issues?
Yes,
Um,
absolutely.
Mm. Yeah, I think that's a very good point. I do think that that's the case, at least in some respects, right? Japan is a very extreme system. So again, when people say, um, Japan is unique, Japan is it's bespoke. There's nothing like it. It's really true because I don't know if you listen to Hardcore History by Dan Carlin, but if you listen to his series on the supernova in the East and the Japanese imperial expansion in World War II, one phrase he says is that the Japanese are like everyone else, only more so. And so all human emotions, the Japanese will take it to the 150% extreme. So if it's patriotism, they'll be 150% patriotic. If it's duty, it's 150% duty, right? It's any emotion, any logical output of the system, but only more so. And so when we talk about monetary policy, right, and the deflation of the housing and asset bubble in the 1980s, from the 1980s to the 1990s, we see these more extreme solutions being tried, and then the people actually accepting it really without much pushback because of the inherent trust and the stability of the government, right? They have a very, very strong, I guess you call it like cultural belief in the government and the authorities. And so that means that it's very easy for central banks to go ahead and try these things. And then Japan is also facing, right, this demographic wave that is 10 to 20 years before ahead of the rest of the West. They have been seeing declining birth rates ever since about 2016, right? But way below replacement level. And, I heard a stat which was pretty crazy to me when I was in Japan, that they're losing around 500,000 people every single year now because they're a country of 100 plus million people, but the birth rate is so low and so much of the population, right, about a third of the population is over 50. And so you have this huge wave of people who basically are all elderly and having to be retired and living on pensions, and they're starting to withdraw and take money from the government and not be tax I used to call it like a net tax positive for the system. They're net tax negative, and that's putting more and more strain on the system. And so that means that the system is slowly contracting, and the push towards low interest rates and the push towards, I guess you could call it like financialization or monetization of the financial system is something that we'll all face because we're all moving towards this low birth rate, slowing demographics,
Mhm.
higher average or median age world where there's just going to be less consumption, less spending, less economic activity, at least in, at the current rate that we're going. And so Japan is in this, scenario where they've tried QE, they've tried, low interest rates, and then finally, in 2016, they started doing yield curve control in September, and they brought the 10-year yield all the way down to 0%, and they kept bans there until December 2022. And the only reason they started changing their entire like monetary policy that's been in place for the last 30 years is because of something called the carry trade. So because rates were so low for so long in Japan, investors like hedge funds, pension funds, even individual retail investors could go out and borrow yen at 0% or even, negative real yields, right, at certain banks. And you can go and exchange those yen for dollars in the foreign exchange market, and then you can invest in U.S. dollar-based assets that yield higher. And if you hedge your sides of the trade, then essentially it's free money, right? You can borrow tons and tons of yen, millions of dollars worth of yen at zero, and you can buy millions of dollars worth of assets at 5% of whatever the 1 month U.S. Treasury rate is, and it's essentially like a free money glitch. And that investors were doing this, for decades, but this really accelerated, especially in 2022 and 2023, as the Fed began their hiking cycle. Because when the Fed was at zero, and when the domestic Japanese financial system is pinned at zero, there's not too much arbitrage to be had unless you want to invest in U.S. equities, which is obviously much more risky. But once they're able to, bring the Fed funds rate up to 3%, 4%, 5%, and Japan is still at zero, then carry traders can go out in force and put out tons of leverage on their trade because now the profitability makes a lot more sense, right? There's a huge spread now of 5% that they can profit from. And so all this pressure started showing up in the yen. So if you look at a chart of the yen from February of 2023 to October. Oh, actually, no, 2022, excuse me. From February of 2022 to October, it blew out from 110 to 152 to the dollar. And so that's a devaluation of about 30% in just, 7 months, 8 months. And that that pressure forced the BOJ to start to engage in some, I guess you could call it like emergency measures. So first they started doing interventions in September 2022. They blew through $35 billion or so a month in September, another 40 billion in October to try to stem the devaluing currency. Then in December of 2022, that's when they said, okay, well, we're going to move the bands of yield curve control and try to shake things up in the bond market because maybe that will higher yields domestically can offset this pressure on the currency. And so they tried that. Again, it's always a stopgap measure. It worked for a short time, and then the yen started devaluing again. And so throughout 2023 and then up into 2024, the devaluation continued. 2024, they continued to do interventions, especially they did two of them right after the BOJ meeting in April of 2024, and then as well as after the Fed meeting, just like an hour after the FOMC meeting ended in May of 2024. And again, it didn't really work. They were temporary stopgap measures to stop this yen devaluation because the fundamental pressures don't change, right?
Mhm.
When the BOJ is at 0% of their version of the Fed funds and the Fed's at 4 or 5, there's just way too much yield there for investors to ignore. And if Japan wants to keep their capital account open, which they have to in order to facilitate trade, that means they have to allow money to flow in and out, which means investors, hedge funds are just going to take advantage of that. And so it was just pushing and pushing their currency farther and farther out. And that meant that the inflation was finally returning to Japan, and so they finally switched tacks. And in August or July, late July of last year, they finally got rid of yield curve control. They kept moving the bands. Then finally October is when they officially got rid of it. But they started reducing it. They signaled less QE purchases, and then they basically signaled to markets that they're going to allow yields to start to rise. And so we've seen, especially recently, right, the yields on the 30 and 40-year bonds start to spike. The 30-year just today crossed 3.1%, which is the highest since May. And then the May high of like 3.15% was the highest in recorded history for the 30-year. The 40-year has also been breaking all-time highs basically every single month. And so they've shifted, right, the pressure in the system from the currency to the bond market, because if they allow yields to equalize with the US, that will put off some of the carry trade pressure. But my contention with people who believe that that's going to continue is that the Japanese government is already basically insolvent at 0%. And so at 3% or at 5%, it's completely unsustainable. I mean, like, let's say the Japanese government tried to equalize rates with the US, they would be paying 11% of their GDP in interest expense alone if you refinance the entirety of maturity profile at current Fed funds rates, which is like 4.5%, right? 11%. Now, I don't know about you, but I don't think it's sustainable for a country to pay 11% of their GDP in interest expense. It's just because at 260% debt to GDP, it's just unsustainable. You can't do that. So this is a temporary stopgap measure, but I expect the yen to continue a devaluationary or deflate, a loss in value against the dollar in the foreseeable future.
Well, I'm glad that you mentioned demographics because that's also a component I had in my mind. So I'm glad you went there and
Mhm.
mentioned that because that's also something that I think goes under the radar. People are just not thinking about. So I'm glad you brought that up. Thank you.
Mhm.
And then I read an article. I'm just going to bring it up this morning. I read an article this morning before we're recording this, and it was also talking about it goes into Japanese banks, global markets, and bond prices, things that you've just covered. But it also mentions that it's starting to see Japan itself starting to see soaring prices, especially with regards to rice, which of course is a staple over there. So again, that's going to have another impact, not just on the country itself, but also on citizens and disposable income and so forth.
Yeah, absolutely. And rice is a unique one because so Japan actually has tariffs for rice. And the reason why is because obviously the Japan is a net food importer and they're also a net energy importer.
Mhm.
And so what that means is when their currency blows out, the price of two items in the CPI basket, food and energy, which are obviously I'd say most important to have for most people for survival, they start to blow out as well. They start to increase. And Japan has tried to enact protectionist measures like the tariffs on I think they have like 25% or more tariffs on rice, and it's higher for certain countries because they want to protect their domestic rice industry and make sure that they're actually producing a lot of it at home. But even still, they have to import, I think, around 30% of their total rice supply every single year. And with certain years, obviously, with the rice crop, it can get worse than that because you can have, diseases that spread through the rice, or just a bad harvest season, and that means that the overall yield of the crops go down. So Japan has tried certain things, but overall the problem is, geopolitically or geographically, their home islands are not set up for they don't have enough natural resources to make the entire country self-sustainable. There's a little bit of lumber, there's some rice, but there's not enough farmland for other crops in any sizable function. There's also not enough, you could call it, pasture land for animals to graze, so that they're net meat importer too. And again, all of this means that the Bank of Japan really does and should care about the exchange rate of the yen because that is basically like the barometer for their food and energy for the foreseeable future.
I'd imagine you're also pretty fortunate at present that a barrel of Brent crude's trading around $70, give or take. So again, as you've pointed out, once that starts going north, which I would imagine in the long term it's going to, then that's going to
Mhm.
have an even more of an impact on the Japanese.
Absolutely, absolutely. They import, I think, 95% of their overall energy, their natural gas, the LNG, their petroleum and the other oil products. Like it's it's a real issue if you're sitting at the policy helm of the Bank of Japan, or even if just you're in the federal government, right, and you're prime minister, you need to be worried about this. And this is the same geopolitical issue that Japan faced even in World War II. That's part of the reason why they were so expansionist is because they needed the oil facilities in, China, in Southeast Asia, Indonesia, in order to produce enough energy for their war machine. And once the US was able to cut off those supplies, it became very, very, apparent to the Japanese that they were now going to lose this war just because they didn't have enough gas to run their destroyers around. And today we don't have, luckily, we don't have a war going on, but we still have an economy to run. And if you don't have energy, or if energy prices go up exorbitantly, high, then it becomes very, very hard to run a modernized economy. So I think long term, Japan really has to make a decision here. Do they let the bond market die or the currency die? And you can't save both.
Would that be then a damned if you do, damned if you don't, a catch-22 situation? So if you're in the Bank of Japan, and again, this is
Mhm.
why we started this conversation with Japan, because really whatever they choose, whatever they decide, it's going to have massive ripple effects. So maybe if we can, let's work on two scenarios. Let's save one and not the other, and then vice versa. So what would happen, and what would the likely ripple effects be in both scenarios?
That's a good game theory to play out. So, okay, let's go with the first option. Let's say you let the currency blow out and you save the domestic bond market, which was the policy of the Bank of Japan up until, you know, 2022, and then up obviously 2024 is when they finally killed yield curve control. But they started moving the bands 2022, 2023, right? That's when they start easing up on this excessively easy monetary policy. If you allow the currency to be the release valve for the pressure in the Japanese financial system, then you start to see the prices of, like we said, food and energy start to rise inexorably. You start to see exports, luckily, start to rise because everything in Japan becomes cheaper relative to the US. But the problem is obviously Japan, even though there's a large export industry, a large part of the economy is based on services. And so for domestic Japanese people, for cost of living, all of that would rise, especially with regards to, food and energy, like we mentioned. You would also see, the I guess you would call it like apparent or relative attraction towards Japanese debt start to decrease because unless you're a Japanese investor, unless you spend in yen, you would not want to have an income stream, a fixed income stream in basically coupon payments in yen when the yen is devaluing. And the JGBs have already seen a reduction in liquidity and overall like demand from the market just because of their low yields relative to the rest of the world. But you would see that get even worse. And so that means that ironically, letting the currency blow out means that the bond market would weaken substantially just because the bonds are less relatively attractive, unless you want to hedge the currency risk, which could be very expensive, especially as the skew on those, on those options or on those swaps starts to rise just because of the pressure building on the economy. And again, you can't really, if you're letting the currency blow out, you can't really change the monetary policy because anything you do to save the monetary policy, to save the currency, will start to shift the equation in the other direction, which is the bond market. So if you're not letting the currency blow out and you want to stabilize things on the currency side, great. Then you have to let the bond market take some of the pressure because, like we said, all economies globally have to deal with something called the policy trilemma. The policy trilemma is you have to have an open capital account, fix. You can choose two of the three: open capital account, fixed exchange rate, and independent monetary policy. So if the Bank of Japan is going to be independent, meaning they're going to keep rates low when the rest of the world is going to hike, then they have to give up either the fixed exchange rate or the open capital account. Like we said earlier, they do not want to give up an open capital account. That's required for really an export-based economy, a free market economy that allows trade and investment. They If they want to have independent monetary policy, then they're going to have to give up the exchange rate. And so that means, let's say they keep rates at zero, they allow the currency to blow out, then the currency goes devalues substantially. Or if they decide, okay, we're going to not have independent monetary policy, so that means they would take the bond side of the equation. We're going to equalize rates with the Fed. Okay, so we're going to do all this to save the bond market to alleviate the pressure from the let's say 3 year, 5 year, 10 year, and 30 year yields. Then the way you would do that is by reinstating all of the easy money policies. So you'd have to, restart yield curve control. You'd have to allow, the monetary excess to continue in order to maintain a lid on the bond market and stop yields from getting too high. And that just means, again, eventually more inflation because you're printed the Bank of Japan would be printing money, printing yen to buy JGBs at 0% and funnel that money to the government. And the government would spend it into the real economy, and so that would increase the money supply and eventually cause inflation. Now, Japan is a unique scenario where they've been able to keep this monetary charade up for so long just because of their unique status as the highest savings rate in the OECD, the lowest monetary velocity, extremely old population. Again, old people do not have a high propensity to spend. They're very, very inclined towards saving. And so that means that it's actually pretty hard for the Bank of Japan has been trying to get inflation to happen for a long time. And they found that it's very, very hard, right? You have to print a lot of yen to get even a little bit of inflation. But it doesn't mean that they can defy monetary gravity forever. And so you save the bond market at the risk of igniting inflation domestically. So either way you slice it, you're going to see inflation. And the issue is, let's say you want to take the even the more extreme tack and say we're not going to do anything. We're not going to save the bond market. We're not going to try to save the currency market. We're just going to sit on our hands and let things play out. Well, the 10-year JGB was going weeks without a bid back in 2023 when they were doing yield curve control. Now we're starting to see the 10-year and the 30-year and the 40-year bonds hit all-time highs in terms of yield. So if you want to sit on your hands, great. Now the yield is going to blow out. The government is going to have to borrow an exorbitant amount of money, and I would contend that the bond market will not fund the government at 3% or 5% or even 10% yields. The yields might blow out to 20% just because at 260% debt to GDP, a default is pretty likely at this point.
So if we step out of game theory then for a second, that brings me into this question. So this is what we're seeing. What you've just highlighted
Mhm.
is what we're seeing right now. This is what is happening
Mhm.
as and when we're recording. So using that as because that's what's happening, what then happens next? Not necessarily just in Japan. Let's now try and link this to the rest of the world. What is likely to happen next from your experience?
Sure. So that's a very good question. That's what I answered in the last like couple minutes of the video. People need to understand that Japan has been the global sovereign debt linchpin for the last 30 years. So
Mhm.
be due to their unique factors as the highest savings rate in the OECD, 4 times higher than the US, by the way. They have the highest amount of household assets in cash, something that Weston Nakamura, relayed to me in that mini doc. 54% of household assets in cash, just because with yields at zero, and why would you hold any assets? Again, it doesn't make any sense. The bonds yield zero. The stock market's basically gone nowhere. It's after 30 years, it broke even in April of 2024, 34 years. So if the stock market hasn't gone anywhere in 34 years, if the bond market has been yielding zero for 20 years, there's nowhere to invest. And so what happens is that Japanese retail investors and professional institutional investors invest abroad. They go and find yield anywhere. And what that means is that even low yielding instruments like 0.5% yield on a treasury seems really good to a Japanese investor because they have two options. They can either park it at their local bank for negative zero point 0.1, or they could put it into a U.S. Treasury at zero point 0.5, or a U.S. Or a UK gilt, or a French OET. Like it doesn't th- because their rates were so low, they became the global funder of global sovereign debt, right? They become the exporter of capital into the debt markets. And they really like debt markets because they're so stable. And the Japanese prize stability over almost everything else. But now that the currency is blowing out and now that the bond market yields are finally starting to rise, the argument for holding foreign currencies or foreign bonds is starting to, be reduced. And so, like, let's say that they allow the yields to rise to 5%. Well, now you can hold Japanese yen. You don't have to worry about any exchange risk. You can hold it in JGBs, even in short form JGBs, and you can actually earn a real yield. The reason to own that sovereign debt is no longer really applicable. And if we take the other side of the equation, like let's say, okay, they don't let the bond market blow out, they just let the currency blow out. Well, then if you're letting the currency blow out, then you would probably want to invest in a capital appreciating asset, and something like foreign bonds at 2% is not as attractive as foreign equities, for example. And so we've seen already, like in the last few years, the data has shown that the Japanese retail investors have been shifting from owning global sovereign bonds to global equities. And so, especially the US. So we've seen money, trillions of dollars flow from Japanese holders of bonds, mostly treasuries, but also French OETs, UK gilts, right, into the US equity market, which has driven stock prices higher and higher and higher. And there's a total of $7.2 trillion of household assets in cash that they can still transfer. So that's 7.2 trillion that is yet to even come into the global system. And so, as this process continues, the conclusion that Weston and I came to was that, ironically, it'll actually be very, very bullish for US equities, because these investors will be looking for yield, and they especially want yield in a currency that's not their own, especially if the currency is devaluing. And so that means the US dollar is clearly the place for them to go.
Thanks for that summary. I was just trying to think of the next sort of
Mhm.
sensible direction to take. So we still have a little bit of rope left, given everything that's going on. And
Mhm.
again, the summary that yourself and Weston came to was that moving forward, short term, medium term, US equities look to benefit because of the amount of cash that the Japanese have as such.
Mhm.
Once that either runs out or that starts drying up, to me, then it sounds like, and I don't want to be hyperbole, that to me, it just sounds like financial Armageddon. That if it collapses, if it all collapses, it's going to be quite horrible for quite a lot of people around the globe. Is that a bit
Absolutely.
too hyperbole, or was that right?
No, I think that's right. Well, look, again, if Japanese investors are now finally learning what inflation really feels like, right? The I think the 1 year inflation rate in Japan hit the highest in 30 years in March of this year. I haven't checked the data since we started filming the doc, but it they're finally learning what inflation feels like, which is foreign to most people in Japan, just because it's been 0%, it's literally been 0% inflation for 34 years. And so that makes it a foreign concept, and that makes them more, I guess you could say, like, precluded, or they're more convinced to buy bonds because of that, right? And so as that sentiment changes, and especially as the elderly people start to die off and their pensions are liquidated, and these assets move to younger people who are more prone to invest in equities, we're going to see that capital move from bonds to stocks. And the real, I guess you could say, Armageddon for the world is all that capital was being funneled into bonds globally, because with Japan at zero, like I said, everything else, every other bond seemed like a great investment. But now with Japan no longer at zero, that argument is starting to lose its color. And what that means is that now one of the largest global sovereign debt funder is going away. And with them going away, that means cheap money for everybody else is also going away. Central banks will now have to start doing what is called by Lynn Alden eating their own cooking. So instead of allowing, like the US government, for example, in the wake of 2008, Treasury issued, $8 trillion of debt within 7 years. 80%, about 78% of that debt was bought by foreign investors. So mainly the Chinese and the Japanese, but also European investors who bought US treasuries in the wake of 2008 to fund the US government, but also to get some yield on those bonds. Now, ever since 2015, we've seen there's been an increase of $10 trillion, or maybe 14, actually, $14 trillion of debt. And foreign investors, foreign private investors, meaning foreign central banks, but also foreign institutions, have only bought about 15% of that. So they went from 78% to 15% just within a decade, basically. And so what that tells you is that global central banks, global sovereign investors, are no longer buying US treasuries, especially on the long end, as a long-term investment. They might trade it, they might buy bills. There's still demand, obviously, on the short end, but on the long end, that demand is going away. And if that demand goes away in the long run, that means more and more high yields for the US, more and more high yields for the rest of the world, because you can't you can't do this level of treasury issuance, of debt issuance, with much less demand and still expect yields to stay the same. It's not possible. And so this is why I said that central banks have to do this eating their own cooking. Central banks will have to engage in QE again and again and again, or other liquidity practices in order to funnel funds into the system to buy these bonds because currently private investors aren't doing it.
And it just goes back to the overarching point of this video, this podcast is this is why all eyes really need to be on Japan. Obviously, we can see in the USA, dare I say, the current president is, say one thing, do another, and debt
Mhm.
this and big beautiful bill that. Ultimately, in the grander scheme of things, it will make a bit of a difference, but maybe it's taking the eyes off where the eyes really should be, which should be in Japan, looking at what's going on over there.
Exactly. Because again, as a globe, we lose the largest funder and the what Weston calls the linchpin of the global bond market, right? Because they've been pinned at zero, helped everyone else to be pinned at zero. Now everyone else's yields are starting to go higher, and we're seeing this in the U.S. Treasury rates, right? They're still very, very elevated, and this big beautiful bill just exacerbates the debt problem that the U.S. faces. We've seen this in the UK, right? When with the Liz Truss government in September 2022 enacting the budget proposal, and then the gilt market blowing up within the space of weeks, literally, and the BOE having to step into emergency funding. All of these are small little tremors of what is slowly unfolding in Japan. And as we lose this global sovereign debt funder, yields everywhere have to rise, which is very problematic for the global markets as they exist right now with the high debt loads.
I totally agree with that. Brings me nicely onto a subject I've been wanting to speak about for a while, because I know that you're quite pro Bitcoin, and it's not something that I
Mhm.
know a lot about. So when we do podcasts, we always like to talk about what's going on, and then how can people look to protect themselves and start making these moves to well, protect themselves from what's coming down the line. Of course, a lot of focus is on gold and silver, and I'm very
Mhm.
candid to say I don't know a lot about Bitcoin. I understand the basics of it, but to have someone like you on that obviously understands a lot more, uh, if people are looking to protect themselves, it is could be quite a good thing. Why and how, and go into as much detail as you want on why Bitcoin is also possibly a solid option moving forwards for protection.
Absolutely. So Bitcoin's a really unique asset in the sense that it is a decentralized ledger like protocol essentially that is trying to create a new form of money, right? And this new form of money exists in a way that no other money has ever existed before, in the sense that it is not issued by a centralized entity. It is also not something that's natural, meaning it's not gold or silver. It's not an emergent property of our physical world, like an element is. It is something designed by people, but it's designed to be as censorship resistant, as decentralized, and as I guess you could call it like um, you know, peer to peer as possible. And what that means is that there have been multiple attempts to take over the Bitcoin network, to subvert it, to change it, and every single attempt has failed. And the reason why is because of this, I guess you could call it like a anti-fragile nature of Bitcoin itself. Um, when the progenitor of Bitcoin, right, Satoshi Nakamoto created Bitcoin, he had already studied the previous forms of digital cash that had been invented. And the problem is with digital cash is that you have to solve quite a few very complex problems in order to make it work. Because in a centralized system, it's actually pretty easy, right? A bank has a SQL ledger. In the SQL ledger, they say, okay, you know, Peruvian Bull has an account with 2,000 and Robert has an account with 4,000. And whenever I make a transaction with you, all they do is they have an internal, they have a code that will say, okay, this amount of money subtracted from this account number and this amount of money added to this
Mhm.
account number, and everything balances in the system because
Mhm.
every credit equals someone else's debit. Every plus equals a minus. It's very simple addition, subtraction. And it's all controlled as a centralized entity. The problem that they have to solve with Bitcoin is how do you do that in a decentralized way? How do you have everyone agree on what truth is? And the way that they found, the solution they came up with was using what we call the proof of work system. So proof of work basically means, okay, a normal financial system is either where A, you have a centralized entity that manages all the transactions, or B, let's say this is more like Ethereum proof of stake where you would have multiple entities manage the transactions. And the way you say who gets to vote is that who has the most ownership of the network. So a large entity that owns a lot of money in the Ethereum, like or Cardano or whatever, they get more votes on which transactions are valid and which transactions are invalid. And so basically, every time there's a transaction, everyone votes and everyone says, okay, is this transaction valid? Not. If some big players say it's valid, then it's valid and it gets added to the blockchain. It gets added to the ledger of transactions.
Mhm.
With proof of work, it doesn't work like that. You do not get more of a say just because you own more of the coins. The way they reward people and the way that they order transactions is through a system we'll basically call like anti-double spend, where every transaction from an address is checked against the previous transactions from that address. So they'll look through the ledger, right? Like let's say my address is five. I have, wallet number five in the entire Bitcoin network. Well, I can create a wallet and not add any funds to it, obviously. But if they go back and look at the ledger of all the transactions and no one's ever sent me Bitcoin, then the nodes will automatically reject my transmission because they say, "Hey, you have wallet number five. You've never received Bitcoin in the entire node's history, in the entire wallet's history, which means you obviously can't send any Bitcoin if your balance is zero. So reject it." That's the first way to do it. The second way is once they know which transactions are valid, like I said, which wallets actually have funds and which don't, then they have to figure out, who creates each block of transactions and who gets rewarded for that. And the way they do that is what I referred to earlier, the proof of work system. So again, all these transactions happen. The nodes will double check against the ledger, against the blockchain, I guess you could say, the chain of all these transactions. They say, okay, they're sending one Bitcoin and they've received five Bitcoin, uh, you know, 10,000 blocks ago. And so they say, okay, they received them 10,000 blocks ago, so they do have the Bitcoin. Okay, they can send that. Okay, verified the address they're sending to is also correct. Okay, verified, they're able to send. Now you have to determine, who's able to order those transactions and then get the reward for securing all those transactions in a specific block. And that is the real genius of the system. It's called proof of work. It's a lottery system where everyone is working towards solving a basically like a very complex math problem. And the genius of the math problem is that it's not solvable backwards, meaning like the question isn't 44 times 44 equals what? Because the problem with that is that a faster and faster computer can solve that problem forwards faster and faster, right? The genius of the system is the math question it asks everybody is what two numbers added together equal 100? Now, it could be 50 plus 50, it could be 48 plus 52, it could be 99 plus 100, it could be 100 plus 0, right? It could
Mhm.
you could maybe even go to Nate. So the amount of potential solutions is huge. So the only way to get it is by guessing. And so what all these miners are doing is they're all guessing answers, thousands of times a second, and you have thousands of miners, tens of millions of guesses every single second of the answer. And once one of them randomly gets it right, then they get the block reward. They get the, 3.125 Bitcoin for that 10-minute segment. And what that means again is they now get a reward. They get access to Bitcoin, and the genius of it is that that reward is obviously issued in a decentralized way. No single entity can claim all the Bitcoin and all the money from it because all these miners are competing. And so in there's been a long, complex, technical discussion, but in sum, what this means is that the Bitcoin network is highly secure and it's highly decentralized, meaning that it's very, very hard to crack. To actually destroy, like hack or attack it, you would need 51% of the network hash rate, which is more than the energy output of the nation of Norway. So the amount of money they estimate to attack the Bitcoin network is now in the billions and billions of dollars, right? North of 1.5 billion. So it would be very, very hard to crack. And because of its other features, like its hard supply cap of 21 million, it means it's a scarce asset that nobody else I guess you could say, rehypothecate or print or devalue. And so the attack vectors on it are very limited, which means that it essentially acts as like a digital gold. The scarcity, the difficulty of changing anything in the network, the difficulty of hacking it, make it like a hard money Austrian alternative to the fiat system. And that's why it's gaining value, is because people are seeing its use case not only as a store of value, but also as a potential medium of exchange. And in a system where the fiat financial system is slowly melting down, inflation's rising, debt is rising, people are seeing this as a viable alternative.
So I'll try and summarize as best as I can. And I'm not the most technologically proficient person, so apologies if this
Mhm.
comes through as complete layman's terms. So we have a decentralized asset effectively with a hard limit of 21 million,
Yeah,
you say.
million.
And because of the way that the system works, it's pretty impregnable in terms of, attacking it and so forth. And it is a way to get out of the system. And then because of also the supply of it, and I've seen various charts from, in Gold We Trust, I think they've done a gold versus Bitcoin money supply, and it's projecting that the potential price of a Bitcoin could be, I think it was about $985,000 by the end of 2030, based on gold being about 5,000. Uh, Point being, just those factors alone could actually work as a very good way for people to protect themselves because of everything you said. It means that the price is likely to continue, volatile as it can be, because of the scarcity, likely to increase further on down the line. Therefore, it could act as a good way of protection. Is that about right? Have I missed anything really important out there?
No, that's a good summary. I would say also, you need to think about Bitcoin as, a scarce asset the best way to say it is a finite asset in an infinite world, right?
Mhm.
When people ask you what's the correct, price of gold, what's the correct price of oil, well, the problem is you're dealing with two actual markets. The first market is the market for the actual good. So what's the supply and demand of the oil market? What's the supply and demand of gold? If we go find a gold deposit tomorrow that's huge and we mine it and the gold supply inflates by 10%, well, then the gold price is going to go down just because of supply demand mechanics. The other problem that we face is that there's the secondary market is the market for money itself. So the supply and demand of money also changes. And in a normal hard money system, only the demand for money changes, not the supply. And in that system, interest rates are the barometer with which we view the demand for money. Higher interest rates, higher demand; lower interest rates, lower demand. And the interest rates, by the way, also regulate the supply, right? When you have high interest rates in an economy, let's say they have a very high, high demand for money, then people have a greater propensity to lend because why? You can make more interest on your deposits if you put it in a bank, or if you lend it out in like, let's say you're a private credit dealer, you want to go lend people money for a business venture, you can make 10% instead of 5% like you could a couple of years before. So in our current system, the problem is interest rates are not allowed to be that barometer. And so that means that the supply of money itself is flexible, and therefore the actual objective prices of things are not necessarily reflective of the primary market, like the supply and demand. And so, good example of this is even the S&P 500. So if you track the S&P 500 as compared to global liquidity, which is basically global central bank balance sheets plus and minus, reverse repo TGA for the Fed, you find that the correlation coefficient is 0.89, which in finance is extremely, extremely high. Basically, 90% of the time, they're correlated almost perfectly. And so as global liquidity rises, you see stocks go up. And then as global liquidity falls, you see stocks go down. And this is all emerged as a, I guess, market reaction to the financialization and the monetization of assets after the 2008 financial crisis, as the Fed and the ECB and the BOE and the BOJ all undertook record monetary easing programs to save their respective systems. But now with the money supply being so inexorably tied to the debt as well as the financial asset prices, it means that you can't really understand the true value of anything anymore because everything is diluted by liquidity that central banks inevitably
Mm.
add to the system. And Bitcoin is the first asset where, you know, it's not, it's a finite asset in an infinite world where you cannot make more of it. You cannot rehypothecate it. Like I said, you can't counterfeit it. It's impossible. And it allows I guess you call it like a store of value function similar to gold in a world where we see increasing inflation. And so it just makes sense to invest. And even, Michael Howell, I don't know if you've read his work, but he talks about this in his Substack that Bitcoin, so stocks have like a 1.3x roughly lever on liquidity. So global liquidity goes up by a dollar, stock market cap goes up by $1.3. Gold is something like between 2 to 3x. So stocks or global liquidity rises, gold can go up 2x, 3x. Bitcoin, at least in the 2010s, was 9, and even now it's like around 6. So it acts like what I would call like a high beta version of gold, where it's just even more sensitive to global liquidity than even gold is, just because of its small market cap and I guess lower trade liquidity than gold.
One, given everything that we were talking about at the very start, if we're seeing a lot of liquidity issues and challenges or issuance, then just on those numbers alone, it's certainly got a bright future. Uh,
Mhm.
This might be a basic question, but I appreciate there's going to be people listening to this that will know a lot about Bitcoin, and there might be people listening to this that really have not a bit of a better idea now, but still not a great
Mhm.
understanding. So, are there any books, or apart from your own channel, of course, and your own social medias, are there any like key books that people should probably read if they don't have much of an idea about Bitcoin?
Sure. So there's a couple books I'd say. The Bitcoin Standard is a great one to get started with. It's very introductory. That gives you it gives you an understanding of monetary systems, why scarce money is such a great thing for especially like fundamentally technologically driven societies like ours is. Um, I would say the next one I would read is there's also a book called The Bull Case for Bitcoin, which is essentially it's a simplistic book, but it lays out in very simple terms all of the reasons why Bitcoin, has won in the past and why it's going to continue to win and continue to go up. There's also a really good book, like I said, called The Block Size Wars about the the interplay between what happens when people try to change the network, right? Because this book essentially regales the account of a bunch of people who tried to move the Bitcoin network into what are called large blocks. So the current block size, or at least in 2013, the block size could only support 3 transactions a second. That's really low. That's really slow, obviously. The large blockers were, very intelligent software engineers who said, look, this thing, if we need to grow, we want it to grow as a monetary medium. We need more than 3 transactions a second. That's way too slow for the global economy. We need something, north of 20, 30, 40. We need to even scale this to hundreds of transactions or thousands eventually. So we need to increase the block size. The issue was that would have a deleterious effect on the centralization of the network, because if you increase the block size and allow more transactions to get packed into every 10-minute block, then that means the nodes have to obviously have way more memory and data to store all those transactions, which makes owning a node more expensive. And when you make owning nodes more expensive, what does that do? That centralizes it, because now only wealthy, if the nodes tripled in price, mainly wealthy people could buy them. And then retail investors, poorer people can't run a node, and it will, in the long run, centralize the network. And so this battle played out for 3 or 4 years, and eventually the large blockers split off and formed their own Bitcoin alternative. And that Bitcoin alternative is currently trading at $400, whereas the original Bitcoin is trading at $108,000 as we speak on Tuesday morning. So you can see which one won and which one lost.
Mm.
But those are great books to start. There's also there's quite a few other books. The Tao of Bitcoin I'm reading right now. The Big Print by Larry Lepard was just released.
Mhm.
I have the book. I bought it, but I haven't read it yet. But I would say that's another good book. But I would say as long as you weave your way around Bitcoin, but also gold and macro circles, you'll understand the arguments that people are making here, and I think you'll find them pretty compelling.
Well, I really appreciate it. Thank you. As I mentioned, it's not an area that I know personally a lot about, so I've been waiting to have someone like yourself on the show to go into it a little bit more. Just to recap, so we've obviously explored Japan in depth. We've looked at bond markets, we've looked at demographics, we've even looked at rice, and we've looked at how what's happening over there is very much likely to have an impact around the world. We've also done a little bit of game theory about, which is the lesser of two evils and so forth. And then that's taken us into looking to protect ourselves against what's likely coming down the road. And again, you've touched upon Bitcoin there, which is fantastic. Before we wrap up, is there anything that you haven't discussed or haven't mentioned that you would like to mention before we direct
Hmm.
people to socials and so forth?
Absolutely. So one thing I've been exploring is, what I would call stealth QE, right? The ability of monetary authorities to add liquidity to the system without overtly saying that they're easing, right?
Mhm.
If you had told me in 2016 that they could ease without, inflating the balance sheet, I would have called you insane. I would have called you crazy. But as we've seen ever since COVID, of course, a lot of these conspiracy theories have been shown to be true, right? That the authorities, people in charge, want to have things run the way that they, to keep this in a way that keeps the system currently as it is maintained. And one thing that they've done is things like reserve ratios, the TGA, the reverse repo, to add liquidity to the system without overtly adding liquidity. So if you reduce reserve ratios for banks, for example, that's not easy. It doesn't show up on the Fed's balance sheet. All it does is it reduces the amount of capital banks have to hold against deposits. If you reduce the ESLR ratios, for example, for the prime banks in the U.S., it reduces the amount of capital banks have to hold against treasury bonds that they own in case of the assets falling in value. And when you reduce the capital they have to hold and freeze to, have as a counterweight to that, a hedge to that asset, now the bank has more capital to go out and invest. And that adds liquidity to the system. They can go invest, loan, trade, whatever they want to do.
Mm.
And I have a couple pieces written on this. One of my most recent pieces was called Saving the Treasury, but you can go read that. But basically, I go into depth on how the Treasury itself does stealth easing by shifting issuance to the short end. Um, how the Fed has done it with their reverse repo, TGA, reducing reserve requirements, how they can use things like the SLR or the other reserve or capital ratios that the bank that are normally enforced on the banks, so they can change those to increase liquidity. And then also stable coins. I'm thinking about working on a report about how stable coins can help add, significant source of demand for the short end, especially of the US Treasury curve, which can obviously increase liquidity because these short bonds are much more stimulative to the system than long bonds just because they have much less duration risk. Anyone holding them doesn't have to have a bunch of capital held against them in case of them falling in value. So that's what I'm looking at. And my end conclusion from all this research has been the system just needs more liquidity just because it continually has more and more debt as compounding interest has continued to ratchet us higher and as the deficits continue to grow. So more liquidity, more debt means more inflation eventually and more asset price appreciation for U.S. equities especially, but also gold and Bitcoin.
Oh, absolutely. I say no, certainly not financial advisors here, but absolutely, gold, Bitcoin, even silver to an extent would be probably the
Yep.
go-to three things that I think people would say at the moment. So again, please don't take any of that as financial advice. Just having a chat for
Educational.
educational purposes. You know the drill. You know the drill. Well, perfect. No, I really appreciate that. I always like to give people the opportunity to say how they can be found on social media. So what I will say for anyone listening to this on podcast format, if you head over to the Substack post with this, I'll put all of these links in here as well. But Peruvian Bull, if people want to find more out about yourself and your work, how do people find you?
Absolutely. So I'm on Twitter at Peruvian_Bull. You can also look up Peruvian Bull or Roberto Rios, which is my name, and you'll find me. I'm the only verified one with a little bullhead icon as my logo. I have a Substack called Dollar Endgame where I write about like stealth QE, monetary plumbing, global markets. And I also, like I said, I've had a special focus on Japan for the last 2 or 3 years. So you can go through there, and if you look on the right side of my Substack, you'll see a bunch of posts about Japan because those are actually some of my most viral, most widely lauded posts. I also have a YouTube channel, again under Peruvian Bull, and so you can Google Peruvian Bull on YouTube, and it'll pop up with me. And I have, like I said, just yesterday released my mini doc on Japan, so you guys can go check that out if you want to learn more.
Yeah, highly recommend all of them, especially that mini doc on Japan. I watched that this morning before we recorded, and yeah, absolutely fascinating. So again, I will link to all of that in the show notes. Well, Provable, thank you very much for your time. It's been very informative, and look forward to catching up in hopefully 2026.
Absolutely. Thank you so much.